Welcome back to the Business Psychology Hub channel. In this video, we'll review the influence of emotions on share market trading behaviour. Publicly listed corporations can raise cash by issuing shares to investors. These shares can then be sold or purchased through a stock exchange. Ownership of the shares represents a fraction of ownership in the publicly listed business. Investors seek to make a profit from the share market by purchasing shares that will pay a stream of dividends over time, or by purchasing shares that will increase in price over time and therefore can be sold at a profit. The decision to buy or sell a share should be based on a rational assessment of factors that can indicate whether the share price will increase in the future or whether a healthy stream of dividends will be paid to shareholders. For example, an investor assessing whether or not to buy shares in a particular company may assess the expectation of future company performance. In particular, investors can be interested in whether sales will increase over time or whether costs will decrease. In other words, will the company become more profitable in the future? Another factor is the dividend paying history of the company. Companies that have a track record of paying high dividends will be more likely to pay high dividends in the future. Assessing both the risk and the reward of the investment. Reviewing the past track record of key management. Have the management in previous roles been responsible for positive outcomes, or have they been responsible for a period of poor company performance? Assessing how much the company is worth on the stock market. Investors can do this by multiplying the share price by the number of shares that have been issued, and also by assessing the opportunity cost. Could more money be made by investing in a different option than buying the shares under review? There is a growing body of evidence, however, that concludes that human emotions regularly influence stock market buying and selling behaviour at the expense of relevant share market investment information. In other words, when a trader is on the cusp of making a buying or selling decision, their investing decision can be ultimately influenced by their emotional reactions rather than their research or rational calculations. Behavioural economists have found that emotions such as regret, hope, greed, and fear significantly influence individual trading decisions. Regret is an emotion associated with an individual wishing that they did not perform a past action. It's been found that traders are less likely to purchase a stock that they have previously sold at a loss, especially if the stock price is trading at a higher price than the previous selling price. Buying at a higher price than what one has previously sold a share can remind the trader that they've made a mistake in previously selling the shares. Conversely, traders are more likely to repurchase a stock that has been previously sold for a profit and is now trading at a price lower than what the trader has previously sold it for. Hope is associated with the belief that the future will turn out to be positive. It's been found that when a stock price decreases, traders will sometimes continue to hold onto the stock because they hope that there will be a turnaround in price, and they become insensitive to evidence that the stock price will continue to decrease. In other words, the trader does not sell because they hope to recoup the losses, even though they could redeploy the investment to a more promising opportunity. Trading based upon hope is also a type of optimism bias. Greed is an emotion associated with an insatiable longing for wealth, power, and status. Greed is a destructive emotion because a greedy person will not reach a point of satisfaction and will always want more and more. Furthermore, greed is a social emotion. When those around us become greedy, despite our best intentions, we can be infected with their greed. The greed instinct and the fear of missing out can cause investors who have previously followed disciplined investment strategies to follow the crowd in buying up popular stocks. When greed infects a number of investors, there can be a pricing bubble which represents a spike in the share price that does not reflect the long-term fundamentals of the investment option. Investors buying a stock that has a bubble often lose money, as the long-term fundamentals ensure that the share price returns to a lower level. In a bull market, the share price of the majority of shares in the stock market are increasing, and this can lay down the psychological foundations for a general feeling of greed, where shares are being purchased based on the fear of missing out on today's perceived low prices. The reaction by traders results in an additional increase in the share prices, which further fuel feelings of greed and a fear of missing out. If the cycle of an increase in share price leading to people feeling more greedy, which leads to an increase in share price, continues, then there will be a general stock market boom, which often ends when the greed instinct suddenly is replaced by the fear instinct. Fear is an emotion associated with the detection of a threat or possible harm. In the case of the stock market, there can be the fear of losing one's investment. Many traders invest their hard-earned cash in the stock market with visions of making money, and when prices decrease, the investor sees a paper loss. The emotion of fear can give the temptation for panic selling, where the investor sells at any low price to try to recoup some of their investment. Fear, like greed, is also a socially contagious emotion. When a number of investors experience the emotion of fear, the price of a stock can become much lower than the fundamental long-term price. Long-term orientated investors often make a profit by purchasing stocks being sold in a climate of fear. This is because these long-term investors focus on the share price fundamentals. In the next video, we'll review the psychology behind Donald Trump's political strategies. If you're interested in this business psychology course, then please subscribe to this channel.